The question, I got tons of them from people. I know you got the same one. All right, Trump came, went, nothing happened. Deep state's still in there. The manipulation is going to go on forever. We're all screwed. We should put our heads in the sand. It's over and give up and all those other uplifting sentiments. But what would you say to folks who are feeling that way today? Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And ready for this month's Andrew Maguire call. A little bit delayed, although I have a feeling it will be well worth the wait. Certainly some exciting things happening. We had inauguration, what did or didn't happen behind the scenes. We have JP Morgan lawsuits, and we'll dig into some of those. Although, Andrew, it's a pleasure to see you again today. How are you doing, my friend?
It's great to be with you, Chris. I was just in the middle of reading my book.
I heard it's like the Gray Sports Almanac of the silver world, and I'm glad that made it over there. You got a nice signed copy, I hear.
Yeah, the shame is it cost you one of these to even post it.
Well, I guess maybe that's what I didn't get in my 20s earlier on, where you think now about the things that a piece of knowledge, sometimes is worth millions of dollars, or an ounce of silver, all relative depending on how you look at it and what you can do with it, which I appreciate is what you come on and help us do each month. Before we start, I might add this episode sponsored by Miles Franklin. So if anyone's looking to buy or sell physical silver, Andrew, I know you have a crowd of institutional investors who follow you. So can always check in pricing on anything at Arcadia at milesfranklin.com if you're looking for physical, which we will dig into the physical market with Andrew today. And Andrew, although I guess we're recording the day Thursday after the inauguration, and perhaps to begin the question, I got tons of them from people. I know you got the same one. All right, Trump came, went, nothing happened. Deep state's still in there. The manipulation is going to go on forever. We're all screwed. We should put our heads in the sand. It's over and give up and all those other uplifting sentiments. But what would you say to folks who are feeling that way today?
I'd say, look, we're going to tell you why that's going to be in the history book, and why this will be a history book in no time at all. And I think there's so many questions. Yeah, we fielded a lot, and if there's anything I miss here, but let's kind of go. What I'd like to do, Chris, is, because each time we do an episode, then we need to pick up the various threads from our last interview. And I know because since then there's been questions about some of the things we talked about, and I think the first place to start, because this is the
month and a half ago, you never know what felonies JP Morgan's committed since then.
Well, I mean, hour by hour, we have to. Sometimes we'd
have to make it a daily show to keep up.
Well, that would be fun. But I guess really the immediate place where we should start is because, I mean, New Year action. I mean, come on, we need to put that into context with a larger picture, because so it's probably best perhaps to start by getting right into the weeds, because this is where most of the questions I've been receiving kind of revolve around there. And then we'll look at what to expect medium and long term for both gold and silver, with a particular focus on the end of the second quarter, which is important, and where we expect the culmination of a deeply fundamentally and technical oversold $500 rally in gold, and at least a $10 to $12 initial rally in silver. Now, once that rally starts, though, it's going to take no prisoners. But now this is going to culminate with the implementation really of Basel III rules, and we're going to pick up that thread in a mo. But more immediately, drilling down into the action as we move through, which is, gosh, this is the third week of 2021. Chris, I can't believe it. But I mean, in the first 2 weeks, we saw some amazingly counterintuitive action. And it can be summed up really quite simply as a flush of fresh spec longs who jumped into gold and silver future contract naked long, utilizing money borrowed from the criminal market making insiders, which we call the house, of course. And that left a large vulnerable gap to fill right back into the exact December 15th rally points in both gold and silver futures. So it's important to know this is not all hell broken loose. This is a simple technical retracement. In fact, it's bullish. Now, let's not forget, this rally actually commenced from the rally into New Year. It commenced right from the mid-December stair step. And really, if you think about it, most institutional money had squared the books by the 15th of December, ahead of what was really a very thinly traded Christmas holiday. Now, from a wholesale market perspective, witnessing the gap open on the first trading of January had us really cautious that this gap would be technically closed before the physical market could catch up. Because if they hadn't done something about this, the insiders of the house hadn't done something about this, the physical market would have adjusted to this price. So it had to be slammed down. And so basically, especially if you think about it, I mean, we're conditioned to these things, and everyone that's on your show knows these things. When you get upcoming Fed events, and there were two in the first week, there was FOMC and non-farm payrolls, both which have been historically heavy for gold and silver. But this 3-week New Year retracement event ran into very strong institutional buying, which is still present in central bank and sovereign size at this mid-December closing level. It's important to understand that, because that is a solid stair step. Now, if you remember, that was 24.5 silver, around 18.20 in gold. So these are levels that will never, ever be breached. Now, this gain pullback offered up a huge opportunity to pick up cheap bullion, currently valued by all the first-tier banks and liquidity providers, everyone we speak to, at, well, really close to $500 below fair value. And when I say fair value, I'm talking about a fair value derived from paper market dilution. Now, footprints make it clear that it was the Bank of International Settlements, the BIS, who was behind the selling, and with a very good idea why. And how do we know this was an officially sanctioned sell-off? It's easy, because the stage sell ignition orders laid at each of the full set of moving averages, they massively exceeded intraday position limits that are allowed. Now, given increased regulatory scrutiny and large fines evident for regulatory breaches, not a single market-making bullion bank would dare to exceed position limits without a free pass. Now, it was so blatantly obvious that the spurious timing and size of these New Year sell ignitions grossly exceeded position limits. It's as simple as that. But officials, if you think about it, they openly admit intervening in all the foreign exchange currencies, of course, which include gold and silver, as they are, and also the primary dealers that operate for the officials are exempt from CFTC imposed CME position limits in the directly related gold and silver futures markets. Obviously, if they're operating in the foreign exchange market, they're also operating in the futures market. And it's often forgotten, though, that gold and silver trade as a foreign exchange cross. Now, these positions are either long dollar, short gold, or long gold, short dollar. And to give an idea of scale, over-the-counter gold versus the dollar constitutes over a $15 trillion a year market. Now, aside from the fact that only insiders acting as agents for officials would be naked short ahead of a node intervention, not a single first, second-tier bullion bank or any trading desk for that matter is naked short gold or silver for their own book following the EFP blow-up last year. Now, following hundreds of millions of losses after the March 23rd debacle, no compliance officer would allow it. And we know this firsthand. So basically, essentially, as we partly evidence, as you will evidence by tomorrow's grossly delayed COT report, you're going to see, just like the footprints were hidden in the last Friday's deliberately delayed COT report, it's going to be seen that this was purely a house-generated PSYOPs operation to trick out the last few rinsable long specs. And we saw a hell of a lot get rinsed out. And that includes incentivizing remaining spec longs to add shorts to protect what little long open interest remains. So you never forget that they are not just short, going naked short, they're actually or dumping long positions. If you have, a lot of these speculators need to protect those positions because they're embedded and there's other things that relate to them that they may have borrowed against or whatever. So, but in each and every one of those situations, the insiders take the short side, and ultimately that creates an ignition to move back higher. So basically, really what we're looking at here, I mean, we're talking about a casino, aren't we? We're talking about being able to, what we're actually talking about. And the reason for this, and I think we needed to tell you the reasons for this. So footprints in the over-the-counter market futures has evidenced the ejecting through this rinse of very large BIS unallocated gold positions surgically dumped into a known volume of visible futures long stops layered at and below each of these full sets of moving averages, which were targeted and rinsed. Now, it's just a simple equation. Known margin long stops, visibly sitting on the books of this house, determine how far the house can push price before delivery demands overrun what can be squared for cash. I mean, that's how a casino works. The house insiders keep 95%, the speculators keep 5%. So with specs rinsed and wrong-footed, we probably figured it would take until inauguration volatility to settle before we started to see strong legs appear in both gold and silver futures. Now we see this starting and continuing. So basically, as I say, given the strength though, and the tightness for immediately deliverable supply in the physical market, and this is where we need to bring the wholesale market view in, the spot market, basically the spot market is is so strong, it is going to actually provide what we call a put under the market. Now, obviously, we've experienced a put under the market in stocks because of the Fed, but now we're looking at a put that is appearing in the market because of we're going to go through more of the reasons why this is going to happen. But essentially,
Biden green energy put. I want to get trademark name on it early.
Yeah, exactly. So, I mean, essentially, that's what you're talking about. You're talking about a need now. The BIS is dumping unallocated positions. They're looking to get out of those positions. And basically what we're looking at here is the ability to get out of those positions before June 28th. And, given the strength and tightness for immediately deliverable supply in the physical market, the spot market is going to continue to be well bid and ultimately force discipline on insiders gaming the paper market. Now, to anyone, I mean, obviously we looked at the COT report from last week's 12th of January report, and it revealed the extent, and a lot of people have looked at this, and you realize the extent of speculative wrong footing that insiders had hidden in the previous January the 5th report. I mean, it beggars belief, Chris, that in this picosecond world, the CFTC allows this CME, self-regulatory organization, to deliberately delay publishing this report for an unbelievable 3 days, despite the electronically captured data is available by the close of each business day. And to anyone doubting this, and this probably shows the fact that, that of my age, but to anyone doubting this, data is available for publishing daily. And to illustrate just how rigged this COMEX casino is, now the Tokyo Stock Exchange, the TOCOM, used to publish granular data on every member with a seat on the exchange every single day, split down into exactly how many individual longs and shorts were held by each reporting bank down to the last trade published each day, and actually published within 3 or 4 hours of the close of that day. And this is important because, you know, we were fortunate to have, before Adrian Douglas from GATA passed away, he provided a perfect example of and how this transparency at that time when that TOCOM reported was leveling the playing field. And in fact, Adrian tracked Goldman Sachs's 55,000 TOCOM short position in gold. That was in 2006, being fully unwound to a net long position at the exact period Goldman Sachs were actually covering there and shouting about, shouting about short gold. There was foghorns everywhere, short gold, short gold. And this entire time that they were doing that, we could evidence through the TOCOM positions that Adrian discovered that they were actually dumping their shorts. And in fact, not only did Goldman Sachs ditch this massive 55,000 short lots, they moved net long into repeated gold sell advisories. And they managed to complete it, though, interestingly, just before gold rallied strongly in 2010. Now, as you can imagine, this data is invaluable in assessing what every single market-making bank trading on the COMEX was also doing on a granular level. Now, this information enables us to trade on a much more level playing field. That's what transparency allows you to do. And this is why the COMEX, undoubtedly assisted by the BIS, lobbied TOCOM to stop publishing this data, which they did. And by the way, it's no coincidence that Goldman Sachs and every other first-tier bank is positioned long physical gold and silver now. So looking at, so basically in summary, I mean, we can kind of sum this up. Both GC and SI evidenced the ringing of the House Register on the latest report painted data, but by design provided insiders the opportunities to cover shorts as specs at the specs expense, but to also add longs to benefit from an upcoming large revaluation in gold and silver. That's just what they did now in this first and second week in January. So basically, so before leaving the short-term view, and we'll look at the other information, but we expect ongoing volatility as unallocated contracts get closed ahead of Basel III, June 28th deadline. And again, we'll look at this deadline and how the steamroller attempt that the LBMA have been putting in play to delay the implementation, and how that's going to fail. But on the plus side, we also evidence bullion prices, again, some $500 below fair value, being accumulated by insiders into the closing of long gold, short dollar, unallocated FX gold positions. Now, balancing this is, of course, a very large short gold, long dollar FX position, which will need to be squared and kick into play just as the specs run out of rinsable spec futures open interest to cover into. Now, all of this is coming into play into deeply oversold futures market conditions. And this is so structurally very bullish. And I do want to pick up on Basel III thread, but let's purse foot. This is very important to put the catch-22 trade that is going to provide this massive put under the gold and silver market going forward. And this picks up on one of the threads from our last interview, the catch-22 arbitrage trade as this also T-bones the LBMA attempts to delay the implementation of the Basel III NSFR standards. Now, we looked at this arbitrage trade in more detail last time, but this new constraint upon the house is backed up by what we're evidencing in the wholesale market, which is really important. And this is important as it is just one more of the jigsaw pieces that radically change the paper to physical game as we move into the second quarter. This is unprecedented and history making. Now, COMEX market making insiders will need to avoid triggering backwardations large enough to activate this catch-22 arbitrage trade. Now, Chris, as you probably know, Swiss refineries are backlogged for both gold and silver. We're waiting weeks. Premiums for immediate delivery are required in order to front run orders stacked for processing into an extremely backlogged refinery hopper. And of course, it's not just COVID. This is actually strong demand into the fact that there's a slowdown at the refineries. But so really, size for immediate delivery comes at a very large premium to spot. So give you an idea from a wholesale market perspective, from anything over 3 to 5 tons, we have benchmarked sufficient information to determine that this is currently commanding at a minimum 2 to 3% charged over spot. Now, that's quite a lot, and by historical standards, and we're talking 3 to 5 tons here. But larger central bank and sovereign size central bank demand commands significantly higher premiums. Now, physical cannot be magicked out of thin air. And with such large discounts to fair value, a race into physical will drive the offer to sell bullion higher. Hence, the strong sovereign and central bank spot index buying we're evidencing with the first-tier market-making bullion banks hanging on to their coattails for dear life for their own books. Now, this condition is providing this unseen, massive put under the market. Now, the tight supply and premiums for physical will govern how deep officials are willing to offer technically deliverable COMEX registered inventory for sale. Now, if it is sufficiently backwardated, it will be drawn down. And if you remember, in November, we uncovered that $40 premiums were required to pay off the 10 tons that were not held by insiders, the 10 tons that were required for delivery. So in other words, for them to not take delivery, these fully paid up COMEX long holders were settled for cash. And the reason it was $40 was it was the exact premium required to access 10 tons of bullion accessible for immediate delivery in the global market, which is pretty close to the percentages we just talked about. Now, since November, insiders have been very careful not to exceed 90 cents to $1 backwardations through the entire sell-off. Now, officials and agent insiders have avoided triggering this catch-22 arbitrage trade. And that's the sole reason the New Year sell-off failed to get more traction. And you need a minimum of $1.80 to $2 backwardation to really to trigger a physical buyer that would cover off delivery and transportation friction. So by keeping it under that level, that is where the formula for the put sits. However, into dips if you remember last Friday's chart painting and the Monday capitulative rinse, February futures did flash dip into an actionable backwardation, which is interesting because I know there were a lot of people, and we all looked to see if anyone got filled. No one got filled. It's really important to keep in mind that, as we know, these COMEX inventories are being sought after, but they're structurally rehypothecated, and deliveries, as we know, represent little more than paper warrants shuffled among market-making insiders. And so what is notable is that on each occasion gold futures dipped into an actionable $2 backwardation, it was immediately flash covered within 1 to 2 seconds. Now, in other words, futures were brought by the house to cover. Now, it's really, really odd because it should be first in, first out. But for these guys, for nobody, I know that there are several several major players sitting here ready to jump on that trade. We invited the sharks in. We went over Twitter, we went everywhere saying, come on in, guys, coming in on this trade. This is a perfect way to get yourself 2, 3, 4% over gold and be settled for cash. And you don't even have to take delivery. And so this it's clear, it's really strange that when you have a first in, first out, when you really, these guys should have got filled. No one that we spoke to, and we did go and call everyone around, no one got filled. Now, so it's suspicious. Now, this disciplining effect really, though, is the sole reason gold was not able to be rinsed through the gold futures 1800 level. Round numbers are always targeted. And that was despite the downside momentum ignition into paper thin conditions. Now, so it's important to be aware of this governing factor. The game of who blinks first has changed. Insiders have no gold warrants they can convert into physical deliveries, while the house insiders in the crosshairs to deliver these warrants cannot afford to cash settle another failure to deliver. And as we said last time, the sharks are circling for another risk-free getaway. So really, the only question is, how much of the backwardated conditions were covered off by insiders and how much was auto-triggered by the catch-22 trade? Now, we know none were that we could see. That this will become clearer by Monday ahead of the February 26th options expiry next Tuesday. But one thing for sure, the physical market actors will be seeking to capitalize on any follow-through momentum selling. So this is why the put exists. So really, this leads into Basel III and some of the most recent questions around this. And as we discussed last time, Basel III net stable funding ratio standards coming into the front burner in March will begin to devalue unallocated gold and begin to treat physical gold at very close to an equivalent cash asset. Now, given unallocated gold receives an 85% haircut, this is a game changer and leads into a clearly sanctioned gold revaluation. Now, this timing jives with 2,500 gold revaluation target assessed by most of the first tier banks. And there's been a lot of discussion around the LBMA's attempt to halt and failing that effort, try to delay the implementation of Basel III initiative. However, most importantly, it is not the case as far as the US, Switzerland, and the EU is concerned, all of which will implement the 85% haircut on unallocated gold by June the 28th. That's a major important effect because given physical gold's fungibility and that the primary global physical trading hubs and refineries are centered in Switzerland and Europe, and that all the market-making LBMA bullion banks also have physical presence in the EU and Switzerland, like it or lump it, they will largely be exposed to these standards at the same date. Now, this will impact the hundreds of tons of unallocated gold cleared every day by the LPMCL. These member banks that are part of that clearing process, as it opens up a massive arbitrage opportunity for a physically starved market at current prices. So only a higher gold price will incentivize more bullion to be put on offer in the first place. So also the LBMA member banks exposed to EU and Swiss compliance will not be able to shuffle paper position for settlement if it is not backed by physical, if it's moving into those jurisdictions. It's not the case right now. So there's a big change coming. And even if COVID-19 delays the full, I mean, what an excuse, really. That's absolute crock. But even if that was used as an excuse to delay the full implementation of Basel III in the UK, the cat's out of the bag. With at least a $500 gold price anticipated into the second quarter, we're going to see first tier banks adding to their net long books. And it's already obvious that no one is naked short gold. Furthermore, way into this, the bullish wave, that the spec paper gold and silver open interest that you would need to cover into is actually running extremely thin at the same time. So these rules will extinguish and force to market any unallocated gold contracts that are not closed or squared by June 28th. UK aside, but as we've explained, UK are caught in a noose. Now, the closing of billions of dollars of unbacked unallocated gold contract is required to comply with Basel III net stable funding ratio. And this is required ahead of this, what we feel is going to be this sanctioned and very necessary gold price revaluation. And there is no coincidence that the BIS needed to implement this despite all the lobbying. Now, the action following the BIS defensive action that commenced on January the 6th has evidenced a series of consecutive fixed painting exercises. Now, we evidenced this again last Friday, as we say, and given the counterintuitive paper to physical action experienced over the last 12 sessions, we're doing this on Thursday, so this is the 12th session, and really actually no 13th session, but into yesterday's capitulative attempt, we're quite certain these efforts are directly related to Basel III preparations, namely an attempt for the BIS to unload as many unallocated contracts as possible, which are directly related to large rehypothecated GLD holdings, which have to be marked to market on the deadline of June 28th. Now, Chris, this is huge. When you think about it, you remember we talked about the implausible hundreds of tons of gold and that supposedly flowed into GLD and, of course, in SLV, which is the same situation. We'll talk about that in a little while. But how much these hundreds of tons supposedly flowed in after the March debacle, we knew this had to be unallocated gold. There was nothing available for sale during this period. Swiss refiners were actually shut down and the physical market was frozen. Thus, these positions have to be allocated by June 28th. Now, this is huge because GLD, as you know, is a large, that holds supposedly a large store of physical, and we know that it's rehypothecated essentially. Now, what is key to factor in when we make trading decisions is that the race to unwind unallocated gold positions is actually a two-edged sword. So you have to think about this. The size of these unallocated over-the-counter positions are massive. So we must expect some short-term volatility. But as we've just explained, dips will continue to be jumped on, and that we see some stairs. We'll see the stair step being higher and higher. But despite these immense LBMA lobbying attempts, the refusal to allow LBMA to exempt unallocated gold from the net stable funding ratio forces a massive swathe of unallocated gold to be marked to market in a very untimely manner. Now, this, as I say, is huge opportunity to buy cheap physical gold and silver into every shallow dip, as fresh higher stair steps are now going to be sequentially anchored. And that beggars the question, what will that market price of gold and silver be into the second quarter? And the answer is refreshingly simple. It will be the price a real buyer and a real seller are fully paid for immediately deliverable physical bullion is prepared to either offer the bullion for sale or the price a buyer is willing to pay for physical. Now, it's not rocket science to understand that when unallocated gold is marked to market to square up a position, at a minimum, it requires buying 99 ounces of physical gold to square up a 100-ounce unallocated position. We're being generous here. I'm sure it's a hell of a lot worse than that. But even if the UK operations of the LBMA banks can drag their feet in implementing NSFR, the catch-22 arbitrage trail will run them over. Now, bottom line, there will be an unwind of paper-settled contracts, and the resulting price that gold will be offered for sale in dollars will be a hell of a lot higher. And between now and the end of the second quarter and the June 28th deadline, we should expect some additional volatility as unallocated contracts get closed, as the bad actors race to exit. However, countering the effect of closing unallocated positions, there are thousands of tons of spot indexed long gold foreign exchange positions, which are locked into a cheap price that can and will be demanded for delivery. And with gold and silver trading at important components of the foreign exchange crosses, dollar strength has recently been weighing on spot gold and silver in the crosses against these currencies. However, countering this cheap foreign exchange price gold and silver is also evidencing strong physical demand. So very short term, this bullish driver has not fully offset the heavy foreign exchange action. We're beginning to see that now, but it will serve to underpin dips as backwardations in GC or gold futures have to be managed. And of course, silver, we'll talk about it perhaps later, but these conditions are ultimately unprecedentedly bullish for gold and silver as predatory house accounts seek to load up on physical ahead of widely anticipated at least 20% gold price rise into the end of June. And this will likely be the revaluation point, and gold will be priced in physical terms. Hallelujah.
Well, I think people are ready. Although, Andrew, what would you say if we took everything you just said, yet Silver Chris re-raised you and said, if we tack on Tuesday, apparently, we had 20 million ounces on one day allegedly deposited into the SLV and the Silver Trust. So that is the first part of this month's call with Andrew Maguire. Hope you enjoyed what you heard. I think you're going to want to stick around for the second part where we talk about how to sue JP Morgan for spoofing all over the wise investment I would assert you made when you saw what the governments around the globe were doing, and JP and the other banks decided to commit felonies in response. So we dig into that, a whole bunch of other fun stuff. So even better than hitting the subscribe button, again, in today's environment, you never know when information flows change. So the best way to keep up to date, make sure you get Andrew's call every month, is to win a 10-ounce silver bullet at the same time. But we do send these out directly. So in the link below, in the description field, you can see how to sign up for that. You'll get these updates straight to your inbox. You may even win a 10-ounce silver bullet. So go fill that out now. Stay in touch. We have a lot of stuff that is coming that you'll want to stay posted on. And I will see you soon.